Hello, investors. Most people using Robinhood have no idea they already have everything they need to value a stock for free. No spreadsheets needed, no finance degree, no expensive software. Yet, 90% of investors will still buy stocks blindly based on hype, headlines, or even TikTok. Today, I'm going to show you exactly how to value a stock using only the Robinhood app, step by step, so you can finally answer one simple question before you invest. Is this stock actually worth the price I am paying? Welcome to Push Investments. Let's get right into it. If you're new here, my name is Tim. And if you also here, that means you are interested in building a long-term portfolio using investing strategies. In today's video, I'm going to show you how to analyze any stock inside of the Robinhood app. I'm going to show you the key valuation metrics that I use personally, and I'm going to show you how to tell if a stock is undervalued, overvalued, or fairly priced, and how smart investors use these key metrics to avoid bad investments. Before we go ahead and get into the app, let's make something exceedingly clear. What exactly does valuing a stock actually mean? Well, I'm going to sum it up in one question. Here's the question. Am I paying the fair price for this stock at this present time? It's that simple. So for today's video, what we're going to be doing, we're going to be using the stocks that are currently in our portfolio. Now, for those of you that are new here, you should go ahead and check out the videos before this. I actually show you how I started off this portfolio with $65. I actually showed you how to buy stocks. I actually show you the stocks I'm holding, which is growth and value stocks, dividend stocks, and also growth stocks for the long term. So if you guys actually want to see how to start growing a small account portfolio from scratch, to learn how you do not need thousands or millions of dollars in order to start investing in the stock market, then go ahead and look at the videos before these. Now, for today's video, all I'm going to be using is the tools we have at hand, which is Robinhood app, and I'm going to be using the stocks actually in the portfolio. So the stock I'm going to be using to go ahead and get started with is going to be Oscar, and that ticker you can see down here is OSCR. Now, whenever someone jumps into a stock, the first thing you see is the name of the company and also the price. And most people stop right there. But what you want to go ahead and do, you want to go ahead and do a bit more in-depth knowledge. So here's what I'm going to do. I'm going to go to the double arrows right here, and this is going to be the advanced chart. I'm going to go ahead and open up the advanced chart. To get started, what the advanced chart does, it just gives us so much information which we could use to actually tell if the stock is trading at a fair price or not. Now, to the top here, you have a date range. So you have 1 week, 1 month, etc. And to the left here, you have different matrices. So you could use any of these metrics in order for you to learn how to evaluate the stock. Now, for me personally, what I do, I usually like to go out to a date of 1 year, which in my mind is the center between the 1 day and all the way out to the 5 year or the max. It gives me a better picture. Now, here's the key metrics which I use. One of the key metrics I use is going to be this blue line right here. If I move my cursor, you could see whenever I move the cursor, you're going to see the date to the bottom here. That date is going to change. And if you go out to the right here, you're going to see the price is going to change. So just watch as I move the cursor and you could see the price and the date is also going to change. So what this blue line tells us, this blue line is known as the 200-day moving average. And what a 200-day moving average tells us, it tells us the actual price the stock should be trading at for the last 200 days or the last 6 months. So according to this 200-day moving average right here, it tells us that the share price should actually be around $15.97 or let's say $16. However, the current share price is, you're going to see to the top left here, $14.91. $14.91, you can see to the right here, is below the 200-day moving average. So using this metrics only, that's going to give you an idea that this stock is probably undervalued. However, you cannot use just one matrix in order to draw a conclusion. So that being said, let's go ahead and we're going to jump into a second matrix, which I use to do a quick valuation of a stock. Now, to be clear and to be quite frank, there are several different matrices that can be used, and Robinhood does not have everything. What I am attempting to show you today is that if you want to do a very quick analysis to just get a quick idea of whether the stock is at a good value, a low value, or fair value, then you could use the metrics I'm showcasing right now. So the second one I use is going to be your RSI. You could see down here RSI. Now, RSI stands for Relative Strength Index. What the RSI is that the RSI is known as a momentum indicator. So the RSI actually tells us if the stock or the share price is actually overbought or oversold. Now, let's put things into perspective. If I go right here to the 50 RSI, the 50 RSI is the smack right there in the middle. So any RSI that moves from the 50 RSI as it continues to go up, that tells us that the stock is going into overbought territory. Now, vice versa, if the stock moves from the RSI and it keeps going down towards the 30, it tells us the stock is going towards oversold territory. Now, as you can see, the RSI here is moving from the 50, it's going downwards, it's around the 37 RSI. So this indicator tells me that this stock is oversold, and if I have to use this only, it's going to tell me that Oscar Health right now is undervalued. So now I have two metrics that tells me the current share price of this stock is undervalued, which is going to be my RSI, which is around 37, and my current share price is below the 200-day moving average. So that too also tells me that this is undervalued. It does not stop there. Let's go ahead. We're going to go back to Oscar. And now we're going to jump back into some other metrics that's going to help you decide whether the stock is overvalued, fairly valued, or undervalued. So we're going to go ahead now and we're going to scroll down. The first thing we're going to be looking for is going to be known as the key statistics right here. Now, under the key statistic, what you want to be looking at, what's known as your market cap. Your market cap tells you the actual size of the company. Okay, so the next thing we need to be looking at is going to be your PE ratio, or better known as your price to earnings ratio. What your price to earnings ratio shows you, it tells you the price that we are paying for $1 of profit for the company. Now, according to Oscar's PE ratio, investors are willing to pay a negative $13.27 for $1 of the future profits of Oscar Health. So this is never a good thing, because you always want to have a positive price per earnings ratio. That tells you that the company is actually making money, the company is actually growing, and the company is actually having cash flow. A negative market cap is not always bad. It could be that the stock is probably new in the market. So for instance, Oscar Health is pretty much still new in this sector, which is the healthcare sector. And Oscar Health is competing with monster caps like, let's say, United Health, for instance. So the negative 13 does not mean that the company is actually bad. Now we're going to go down and we're going to see one more thing that can be used to evaluate a company, which is the difference between the 52-week high and the 52-week low. As you can see here, the 52-week low here is going to be $11.20. The 52-week high is going to be $23.80. This is pretty good because the spread here is pretty close. Now, all these metrics, you need to be able to compare it with something else. So what you want stocks that have a pretty tight flow like this. Let me give you a comparison. Let's go ahead. We're going to jump into Robinhood stock right now, and we're going to compare their 52-week high and their 52-week low. So as you can see here, the 52-week low is $29.66. However, the 52-week high is $153.86. That tells you the stock is extremely volatile, and that also means the stock is extremely risky. So the bigger the spread here tells you the more risky the stock is. The tighter the spread tells you the more safe the stock is. Let's go ahead and we're going to get back to Oscar. Okay, so based on the market cap, the price per earnings ratio, and your 52-week high and your 52-week low, that's going to tell me that this stock, in my personal opinion, this stock is still underpriced because the PE ratio is still negative. So that tells me the company has room to grow. The company has a bigger market cap, is higher than $2 billion. So it tells me the company is not as risky as if it was a micro cap. And the difference between the 52-week low and the 52-week high tells me the stock is not too volatile. So that means me personally, I'm willing to take some risk. Now let's go ahead and we're going to jump into one more thing that's going to help us evaluate whether the stock is undervalued, overvalued, or fairly valued. Now, what we're going to do now, we're going to jump into the analyst ratings. What the analysts do is that they actually give a projected price of the stock in a couple months or a couple years. And based on that price, then they go ahead and tell us whether the company is a buy, a hold, or a sell. Based on Oscar, they're saying out of 11 ratings, 45% is saying Oscar is a sell. So they're recommending that you sell the stock at this current price. And that could mean that they see that this stock is going to go down in value and is going to be sold off. So there are a few matrices that can be used. Now, of course, there are so much more that needs to go into this in order for you to evaluate a stock. Here's my overall conclusion on Oscar Health. Based on the 200-day moving average and the price trading below that, also based on my RSI is below 50, and then based on my market cap and my earnings ratio, which tells me that the company still has room for growth, I think Oscar Health is undervalued. Hence, that's one reason why I have it in my portfolio. One of the main reasons I have it in my portfolio is because I'm looking to get growth from this stock. So I expect the share price to move from this price going upwards over the consistent future. So I'm also not looking for this to happen over the next couple of months and over the next couple of years. I'm looking at a 5-year outlook for this company to give me some type of growth. So here's another few factors that can be used in order for you to evaluate a stock properly. And these are not going to be on Robinhood. So you're going to have to go ahead and do your own due diligence. So another one that can be used, what I showcased was known as the current PE ratio. What you can use is go ahead and look for the forward price per earnings ratio or the forward PE ratio. That is a better indicator of how the stock is doing. The next valuation metrics that can be used is going to be your PEG ratio. Now, the PEG ratio just stands for price earnings over growth. So, if you have a PEG ratio of less than 1, that indicates that the company may be undervalued. If you have a PEG ratio that's equal to 1, that tells you that the stock is in fair value territory. And if you have a PEG ratio of more than 2, that tells you that the stock is expensive compared to its growth. Me personally, I like to go ahead and buy stocks that are undervalued. Of course, after I do my own due diligence and I decide for myself that that's a stock I actually want to own in my portfolio, then I go ahead and buy it whenever it's undervalued. Now, as a long-term investor, what you want to do, you want to always continue doing the DCA method or the dollar cost average method, which I have showcased in the last 3 videos before this. With the DCA method, all you're going to do, you're going to be doing automatic buys of stock over a certain period, and that way you're going to grow your position in the stock. Now, I did showcase in my first couple of videos that I have. Let me show you right now. I do always leave a cash balance here. The cash balance here is $15.08, but it represents a 20% of the portfolio value. The whole purpose of this 20% of the portfolio value I always want to keep in cash is because although I'm going to be dollar cost averaging into all these stocks here, which I showed you already, what I'm going to be doing with this 20% cash reserve here, if one of these stocks happen to drop by 5%, then that's going to encourage me to decide if I should go ahead and buy even more of the stock. And that includes my dollar cost average I'm going to be buying in addition to my DCA method. So if you want to do a quick valuation of the stock and you only want to use the resources that's available to you right now, then you got to ask yourself a couple of questions. One of the first questions is going to be, where is the share price compared to the 200-day moving average? The next question you want to ask yourself, what is the current RSI? And you need to compare the RSI, whether it's been overbought or it's been oversold. The third question you may want to ask yourself, is the PE ratio reasonable for the growth? Do you expect growth from this company? Do you expect the company to continue trading flat, or you expect the company to be going down? And lastly, how does the stock stand when compared to its competitors? Now, the whole point of me showing you this video is that if you are new to investing, I know there's so much numerous resources out there that may go ahead and just confuse you. But it doesn't matter what brokerage account you're using, you could just do a quick research just like I showcased in this video, and that's going to give you an idea of whether the stock is overvalued, it's undervalued, or it's going to be fairly valued. So to conclude, I'd like to say this. Oscar Health, in my personal opinion, based on that quick study I just did, is undervalued. I personally like to buy stocks in my portfolio when they're undervalued and not when they're fair value or when they're overvalued. And lastly, in order for you to continue to grow as a long-term investor, you don't really need to check the valuation of the stock over and over. This is just an example. As a long-term investor, what you want to do, you want to continue to dollar cost average into good stocks, and I guarantee you, you will see the results in the long term. Now, if you guys got any value from this video, now would be a good opportunity for you to go ahead, like the video, subscribe to the channel. If there's anyone out there you know that's starting to grow a small account portfolio and they think they need millions of dollars in order to get started, then a good idea would be to go ahead and show them this video so they could get some investing ideas. And lastly, before I go, always remember one thing. always keep pushing your investments.